Economic slowdowns are a natural part of the financial cycle. Yet most people wait until the recession has already hit before thinking about protecting their investments. By then, panic has taken over, markets are crashing, and opportunities have disappeared. Warren Buffett, however, follows a completely different path. He never waits for confirmation that a recession has arrived. He prepares long before the downturn becomes obvious, and that is precisely why he emerges from every economic storm stronger than before. This video breaks down Buffett's #1 recession strategy, the single most important move he makes before the economy weakens. You'll learn exactly what he buys, what he avoids, how he positions his portfolio, and how you can copy this approach today. These principles aren't secret formulas. They're timeless strategies that have allowed Berkshire Hathaway to grow through every crash, crisis, and market collapse over the last 60 years. A recession is coming eventually. It may be months away or a couple of years away, but it is unavoidable. What you do before the downturn will determine whether you merely survive it or profit massively from it. Buffett's core mental framework before any downturn Buffett never begins with predictions. He begins with principles. He does not care if economists say there's a 40% chance of recession or a 60% chance of downturn. He does not base decisions on headlines, government reports, or stock market forecasts. Instead, he follows a long-term rule. Prepare for a recession as if it will happen tomorrow, but invest as if the economy will grow for the next 20 years. This mindset helps him stay grounded during market euphoria and calm during market fear. Buffett's preparation for recessions is guided by 3 fundamental goals. 1, protect capital. The first priority is always safety. During recessions, people lose fortunes not because markets fall, but because they hold investments that should never have been in their portfolios in the first place. Buffett ensures his holdings can withstand years of pressure. 2, increase liquidity. Most investors are fully invested at all times. Buffett is not. He holds large cash buffers intentionally so he has the flexibility to take action when opportunities appear. 3, position for future profits. Buffett doesn't want to avoid recessions. He wants to benefit from them. And that requires preparation long before panic hits. These principles shape every move he makes before a downturn. Buffett's #1 strategy: building massive cash reserves. No matter how strong or weak the economy looks, Buffett maintains and increases cash reserves when recession signs begin to appear. This is not accidental. It is the heart of his recession plan. To Buffett, cash is not an idle resource. It is a weapon. Why cash is Buffett's a fortress asset? Buffett has described cash as a financial fortress because it never loses value in a crash, protects you emotionally and financially, gives you the freedom to buy when others are forced to sell. While most investors fear recessions, Buffett becomes excited during them. Why? Because the best companies in the world go on sale during recessions. Historical proof. Buffett's cash strategy works before the 2008 crash. Buffett was sitting on billions of dollars in cash. When panic hit the markets, he invested in companies like Goldman Sachs, Bank of America, General Electric, Burlington Northern Railroad. These investments later earned Berkshire Hathaway tens of billions of dollars. Before the 2020 pandemic crash, Berkshire again had record levels of cash. Buffett didn't rush to buy immediately, but he was prepared. His goal was not to predict the bottom. It was to be ready. How you should copy this strategy: you don't need billions. You need discipline. Build a solid cash buffer. Hold at least 6-12 months of living expenses in cash. Maintain 10%, 20% of your portfolio in cash or safe equivalents. Use money market funds or short-term treasury bills for safe yields. Cash prevents panic and fuels opportunity. Strengthening the forever portfolio. Buffett believes that most investors fail during recessions because they own the wrong company. They own businesses with weak demand, companies with high debt, stocks with unstable cash flow. So before a recession, he focuses on reinforcing what he calls his forever holdings, companies he is comfortable owning for the next 20, 30, or even 50 years. What Buffett looks for in recession-proof companies: he prefers businesses with strong, predictable earnings, low debt, and high cash flow, dominant brand value, reliable customer demand, pricing power. Even during hard times, these companies don't just survive recessions, They continue earning money while weaker competitors fail. Examples of Buffett's defensive holdings. Buffett consistently invests in recession-resistant industries, including consumer staples, insurance, banking with strong balance sheets, energy, infrastructure, railroads, healthcare products like food, medicine, utilities, and basic financial services are essential even in economic downturns. Buffett knows these sectors hold up better than technology, travel, or luxury goods during recessions. Your action step: review your portfolio and strengthen your durable core. Ask, would this company survive 2 hard economic years? Does it have too much debt? Is its product still necessary in a recession? Focus on stability over excitement. What Buffett avoids before a recession. Buffett's strategy is not only about what he buys, but also what he avoids. 1. Highly leveraged companies' debt becomes toxic during a recession. High-debt businesses may collapse, cut dividends, or suffer huge losses. Buffett avoids them long before trouble begins. 2. Overpriced growth stocks. When markets are booming, investors overpay for fast-growing tech stocks. During recessions, these stocks fall the fastest. Buffett almost never loads up on high-valuation companies before a down. 3. Speculative assets Buffett avoids. Cryptocurrencies, penny stocks, and profitable tech startups. Complex derivatives. His rule: never invest in something you don't understand. Before recession, speculation becomes extremely dangerous. Buffett's advantage: concentration over diversification. Buffett does not believe in owning 50 or 100 different companies just to feel diversified. He believes excessive diversification pushes investors toward mediocre companies. His approach: fewer companies, higher conviction, better quality. When you own only strong businesses, your portfolio becomes naturally more resilient. Your action step: look at your portfolio. Identify the strongest, highest quality holdings, reduce or eliminate weak, speculative positions. Concentrate on companies you understand well. Not every company deserves a place in your recession portfolio. Understanding the margin of safety principle. Buffett's entire investment philosophy is built around buying great companies at fair or discounted prices. But before a recession, Buffett becomes even more strict about valuation. The margin of safety means only buying when a stock is priced significantly below its true value, leaving room for economic uncertainty, protecting yourself from downside risk. Recessions often provide the biggest margins of safety because panic pushes prices far below real value. How to apply this today? Avoid stocks at all-time highs. Create a watch list of strong companies. Set price targets based on their fair value. Wait for the recession to drive prices downward. You don't need perfect timing. You need patience and cash. The exact assets Buffett builds before a recession. Buffett's pre-recession preparation revolves around a few key asset categories. 1. Cash and short-term treasury bills. These protect capital and provide liquidity. Treasury bills in particular are safe, pay steady interest, and are backed by the U.S. government. 2. Strong blue-chip companies. These companies have durable competitive advantages, global brands, long-term customer loyalty, stable earnings. They fall during recessions, but they recover quickly and strongly. 3. Essential sectors. Buffett always keeps exposure to consumer goods, healthcare, insurance, utilities, transportation. People cannot stop buying these services even when the economy slows. 4. Businesses with share buybacks. Companies that repurchase shares when their stock price falls help investors automatically gain value. Buffett loves buybacks, especially in recession. The one thing Buffett never does: panic selling. Buffett has said repeatedly, if you're not willing to own a stock for 10 years, don't buy it for 10 minutes. He never sells strong companies just because the market is dropping. Selling during a downturn locks in losses and eliminates future gains. Why Buffett refuses to panic? He knows markets always recover. He only owns long-term durable companies. He has cash to take advantage of lower prices. Buffett's calmness is one of his biggest advantages. Why Buffett never tries to time the market? Timing the market sounds good in theory, but fails in practice. Buffett knows that predicting the exact peak or bottom of the market is impossible, even for professionals. His advice: the stock market is designed to transfer money from the active to the patient. Instead of timing, he prepares. Your action step: follow this rule. Avoid guessing when the recession will start. Build the right portfolio before it happens. Stay invested in strong companies. Long-term preparation beats prediction. Case studies. How Buffett prepared for past crashes. Before the 2008 crisis, Buffett was holding large amounts of cash because he believed the market was overvalued. When the crash came, he used his cash to buy bank stocks, industrial companies, railroads. These later became some of the most profitable holdings in Berkshire history. Before the 2020 crash, Buffett again had exceptional cash reserves. He didn't rush into risky positions when the pandemic began. Instead, he waited for clarity, protected his balance sheet, and positioned Berkshire to buy long-term opportunities. The pattern across every recession. Buffett's strategy is the same. Raise cash, avoid overpriced assets, buy quality companies at discounts. This formula has worked for over half a century. The 5-step Buffett strategy you can copy now. Here is the system you can implement today. Step 1. Build cash reserves, increase liquidity so you can stay calm and take opportunities. Step 2. Strengthen high-quality companies, replace weak holdings with strong, durable businesses. Step 3. Reduce risk, remove high-debt companies, overvalued stocks, speculative plays. Step 4. Create a recession watch list. Identify the companies you want to buy when markets fall. Step 5. Act when fear spikes. When the fear index rises, drop dramatically. That's your chance. Why this strategy works for everyone. Buffett's preparation method works because it does not require complex financial knowledge, market timing skills, professional trading experience, fancy software, high income. It requires patience, discipline, long-term thinking. Any investor can follow this approach. Conclusion: prepare now, not later. Recessions are guaranteed. Timing is not. Most investors wait until markets fall to start worrying. Buffett does the opposite. He prepares